Well, real estate Q&A. Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. Well, is it a good time to buy real estate? What do I do if I have a difficult financial situation and want to qualify for a loan? What if my credit is borderline? Well, listeners have questions, and Mark Pfeiffer is here to answer your question. Mark, it's great to have you on the program today.
Mr. Bob Brooks, always great to be here. Thanks for having me.
You know, of course, we've been doing this for a long time now, and as you and I were talking just before we went on, if you go back I don't even know how long it's been, but you go back 2 or 3 years, and just a totally different real estate market than I think we thought we would see by now.
Yeah, I agree. I think, we post-COVID, you expect the pullback, right? I mean, COVID accelerated the demand. It brought people, to be home buyers that maybe were thinking they'd do it later, but it brought all these people forward. So you expect a slump afterwards. I'm still, we're still working through that, if you want to call it the COVID haze, if you will. But I will tell you, this year so far, it's only been, 75 days at this point.
Right.
Since January 1, the phones have picked up and people are at least, there's a lot of conversations being had. So I don't know if we're starting to come out of that, because at some point people get married, people have kids, people die, people get divorced. The cycle of life happens. And so even if you got that 3% rate on your home, eventually you may need to sell or want to sell that home. So I think some of that demand's starting to pick up. But to your point, yeah, it's been a kind of a wild it's been a wild 3 years post-COVID, but it's been an interesting last year and a half when you thought maybe there'd be a little bit different signs. But I'm hoping this is the year. It seems to be very promising so far.
Well, I will say this, and absolutely want to point this out, is that people in the real estate business, whether it be realtors, people in the mortgage, on your side on the mortgage business, they take the environment as it is and they improve, and they find out how to do things better. So I would also throw in there that that's been probably been a real good thing. I mean, I've watched as you've changed your business drastically, and how you've really brought a lot of things to the table to make this a much more better a better process for consumers, and just some really good things for the future.
Yeah, I couldn't agree more. And what's interesting, and I don't want to nerd out too much, but AI, it's going to be a game changer for the world, obviously, but the mortgage world's already starting to see lift from it. And some of that lift, can be threatening to jobs, including the way we do ours, which is fine. I welcome it, truthfully, because again, at the end of the day, I don't love paperwork. I do love helping people, and I'm good at giving advice, and I've done it for over 20 years. But it's been a game changer as far as how we serve our clients and what the clients can do, and empowers them to make better choices, both financially as well as just an easier process for them, both on the mortgage side and house hunting.
So let me ask you, what goes through your mind? A week and a half, 2 weeks ago, it really looked like that dip below 4%.
I know.
10-year bond. I mean, it looks like this is going to at least be a good 2 or 3 months, at the very worst case scenario. And I was thinking about you working everything, trying to get ready for what's coming, and then just like that, it changes. I mean, but that was the first time, though. Seriously, Mark, here I am telling you this. I mean, from my side, it's the first time that I looked at this and said, maybe a little bit of positive coming back in here.
Yeah, no, I'm with you. And just going back, you can, so for those that don't know, the 10-year treasury, mortgages often follow whatever that is. And so right now it's sitting at 4.18. You're like, well, that means nothing to me. And that's okay. It shouldn't. But just understand that it hasn't been consistently below 4 for quite some time, right? As the 10-year treasury goes lower, mortgage rates go lower. So to what you're seeing, Bob, like if you look at a graph here that I have in front of me for the last, let's just call it 30 days, it almost looks like a V. It's like rates, the V, rates were high, and then they just made a really great 3-week run, and they were making a tear down to the bottom. And then the last, call it 2 weeks, that the other side of the V goes back up, and it's because of just what's going on with the Middle East right now, right? So all that it's scary for a whole bunch of reasons, but the biggest and most obvious impact is just oil. When oil doesn't get delivered the way it used to, prices have spiked, and that's what it does. And when oil is more expensive, everything's more expensive, and that's inflationary, and that's bad for mortgages. So hopefully it's temporary. Hopefully we get back to that below 4. I think we will. It's just a matter of when. But yeah, I think, like I said, I think 26 is setting up to be hopefully a great year. And I'm going to sound a little bit like a broken record, but I'm telling you right now, like, this is a great time to buy a house because the rates, I do think, will be lower in the future. But as you and I have talked about many times, when rates do come down and they stay down, you're going to get a lot of folks that come out of the woodworks, and all of a sudden that's going to drive demand, which will drive prices higher. So I do think now is a great time knowing it's coming.
I wish that maybe you post this on your blog. I think that you were talking about on the charts that what I would call the double bottom, and really that's for people who want to watch. Don't really understand charts very well, but could definitely point to this is good, this is bad. The time, and it'll happen, that the interest rates break through what that chart shows should be a really, really interesting time to be in real estate. So
you're right. And that's one last thing I just want to say as far as to be in real estate is the key right there, because it's, folks always say, like, it's kind of like stock market too, right? You don't time the stock market, it's time in the stock market, right? You can't time the bottom, it's just being in it. But when there's good opportunities, you can't always time the bottom. And that's what you just said was time in real estate. Like, if somebody wants to buy a house right now, whether it's they want to buy their first home or they want to upgrade or they want to buy their first investment property, this is a great time. Historically, like, again, people are like, oh, I'm worried about this bubble. Man, I know that's not today's topic. I'm just telling you from a rate standpoint, this is a great time to get in, because I think what you're going to see is over the next 12 to 18 months, things are going to pick up, and that's going to make prices go higher.
Yeah, and I think to your point, I think it's a little bit beyond talking about a bubble. It's just more about talking about the deals that are out there. And the other thing too, and I like what you think about this. It seems like we really haven't seen that situation where homes are dropping price dramatically. And I think, and you may disagree with this, but I think that we will see that, and it's actually a good sign, because that it usually comes before things start to really, really recover.
I think as a whole, you're correct in terms of we haven't seen a big dip. I will tell you, if my weekly updates that I do a video weekly update thing, and it seems like the repeat record has been that Austin, Texas has been the number one worst real estate market in America.
I heard that. Yeah.
And so here's the deal: 6%. For the worst market and the worst time we've seen since the mortgage meltdown,
yeah,
top to where we are is a whopping 6%. So again, if the worst market in America here in Texas is 6%, Dallas-Fort Worth, I think we ranked like number 9, and we were at minus 3%. And the reason being is, anybody listening here in Dallas-Fort Worth knows, you go to the outskirts of the Metroplex, and there's just room to build, lots of homes to build, and builders have done that, and they need to do it, and they'll keep doing it. And that's where prices have come down, because the builders are willing to give away these crazy incentives. And that has, softened the market. But there's still pockets in the Metroplex where homes are still holding strong. So I would just say, if rates do come down a little more, that inventory, that excess inventory, what's making the builders cut, it won't take but 60 to 90 days at good rates to have that inventory get snatched up. And builders, they take 9 months to 18 months to build a home. So it's not like once this inventory is gone, it doesn't just get replenished the next day. So that's my point, to say that as soon as that inventory that's sitting there and available where deals can be made right now, I think they'll get snatched up. And it's a different story in the Northeast. The Northeast, like New England, nobody's selling. Like, there are still far more buyers than there are sellers. Like, it's a real inventory problem. So to your point, Bob, good for us to be living in North Texas where you can get
Oh,
a
yeah,
little bit of a
absolutely.
deal right now. Like, good for us.
So let's talk a little bit about, and I hope I don't get this phrase wrong. Marry the real estate, date the loan. Is that what is that that?
Yeah, I got to be honest. It's one of those. I say that very carefully, and I don't love the expression, but it has become popular. But I say it very carefully. Marry the home, date the rate. So I make sure to say that last part very slowly and enunciate. But the reality is, yeah, marry the home means it's your forever thing, all right? And buy the home, it's a long term, but a mortgage, to your point, date the rate means that if you buy a home today, you get a mortgage today, there's a pretty good likelihood that your mortgage won't be around for more than the next 12 to 18 months. Because as rates do come down, you have the option and ability to refinance that mortgage, but still live in the exact same home. So
Well,
that's the part to say buy the home before the costs go up.
well, tell me this, and this may be difficult to answer on the radio, but talking about the folks that got into the mortgages with the anticipation of, hey, this is a short term thing. I'm going to refinance when it gets to X. How
Mm-hmm.
sitting in your position, you got a lot of people depending upon you. You got a lot of people
Mm-hmm.
wanting to know when this happens. Let me know what to do, as if we all have crystal balls. But
Right.
this what do you have to see to pick up that phone and go, hey, maybe you want to lock this in?
Yeah, I think that's a phenomenal question. We have, I'm not trying to plug anything, but we do have a calculator where we can go in there and somebody can enter their information, everything they have in their current mortgage, and it'll spit out, here's what your strike price is. Meaning when rates get to this is where you can see a benefit. And in my mind, I think it depends on somebody's crystal ball for their house. Do they plan on living there for the next 10 years or the
Right.
next 2 years? Right? If somebody says, "Oh man, my kid's a sophomore in high school, and when they're out, I'm going to move and we're downsizing." Well, if your timeline's 2 or 3 years, at that point you need a refinance to make sense probably in the first 12 months, because again, you need to see the benefit pretty quick in order to do that. Versus somebody else that says, "I'm going to be here for the next 10 years." If they don't see a benefit for a year till year two, where the savings have justified those costs, that's okay because they got plenty of years to make up for it. So it does come down to somewhat of a personal piece to say how soon you want to make it up. And the real hard part, which I think maybe the underlying question here, is how do you know when to pull that trigger?
Yes.
In other
Yes.
words, how do you know when to do it? Because if rates are going to go down, Mark, why should I refinance today? I'll just wait 12 months, right? September of 2024, rates dipped for a hot minute down to probably levels that they're at today. And for about 2 to 3 weeks, we got a lot of folks that called in. They did loan apps. They did this. And I would say about half of them got greedy. Because in my mind, if it makes sense financially, we can get your money back pretty quick. Let's do it, because there is no predicting the future. The rest of them spent the next 14 months. They finally did it this last September. Coincidentally, it was a year later when rates finally dipped, but they missed out on many thousands of dollars of savings for that year because they got greedy waiting. So my answer is, if it makes sense financially, you like the rates, let's take it. If we end up refinancing again in the future, we only do it if it makes financial sense again. But I don't get greedy. The old saying, pigs get fat, hogs get slaughtered. If you can save a few bucks and it makes sense, do it. You can't just wait for tomorrow, because there is no guarantee rates are coming down. We think they are, but there's no guarantee.
Yeah, and who wants to be in that stressful period for a year where you're trying to figure out when do I pull the trigger or not? I mean,
Yeah, and
that's
not
a
to
tough
mention, like, I
question.
missed it. You missed it. Like, could have saved you $400 a month, and you missed it because you wanted to get $420 a month of a savings instead of 400. So again, if the math works, I'd say take it, do it. And if it makes sense for a quick break even, absolutely do it. And if rates go down again, you can always refinance again. But if they go up, you miss that opportunity. And that's where a lot of folks have been paying a lot of money that they didn't need to pay.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. I do appreciate it. Mark Pfeiffer is here with me today. We're talking about real estate Q&A. If you want any information about Mark, www.mortgagemark.com is where you would go and check out that site. There's a lot of information there. Let's talk a little bit about rate locks. Obviously, at some point I'm assuming, so we'll say it that way, at some point in the refinance process or original mortgage finance process, you can lock the rate. Is that talk a little bit about how that works, as well as are there some programs where you have the opportunity to do it more than one time?
Great question. Yeah, so lock-in rate, and I'll give you a personal example here. I've worked because I've bought and sold real estate before, and I'm not allowed to do my own loan. And long ago, I went to a buddy of mine at another company as a friend, a lady, and she, I was like, hey, let's lock in this rate. And she's like, great. And something was missing in the communication, and it didn't get locked. And the next day, rates went up. I was like, man.
Oh, man.
And again, it's a friend. So, but to answer your question, what do you do and how do you do it and when to do it? So when you have a closing date, whether you're purchasing or refinancing, once a closing date is known, that's when you can lock your rate. So on a purchase, it's when you get your contract. On a refinance, if you say, man, I'm going to close 30 days from now, that's typically when you lock. Most locks are generically done for 30 days. I would recommend whatever you do, if you're locking a rate, get it in writing when it's locked and ask the process and be very specific. How can I confirm this is locked? For us, our current model, the way we've done it for a long, long time, is we make sure it's in writing, both via email, like, hey, please lock me. We say, yes, ma'am, we're on, or yes, sir, we're on it. And then there's also a lock confirmation that follows it. Because again, early in my career, there's too many, I thought we were locked. No, you didn't tell me that. There's always that disconnect. So I think in writing, very plain, there should be that process. I'm not saying every lender does that, but that'd be my recommendation. And then secondly, once you're locked, just know that if rates do get better, some, not all, some companies will have the ability to float down. Sometimes those float downs may cost money. Sometimes they may not. I think that's another good question to ask the lender out of the gate that says, hey, what is that policy? If World War III breaks out and rates just go back to 3%, what does that look like and what do we do? So I think I think a lot do have that policy, not everyone. I think asking good questions up front and getting stuff in writing would be my 2 cents of what to do in locking a rate.
Let's talk a little bit about the underwriting process, which I think was where a lot of these questions come from. And what's it take? Because there's a lot of marginal credit, a lot of marginal financial situations, but people are also in a place where they could actually buy maybe their first home. Talk about, I know this is an extremely important ratio of income that goes to pay debt. It's a non-negotiable. If you don't pay it, something bad happens. Versus cash flow that is free and clear. Talk a little bit about that, because and you tell me that's probably the most important ratio that there is. Was that fair to say?
Yeah, it is. So in the mortgage world, it's called the debt to income ratio, DTI, debt to income. And it's very simple. Take your monthly debt obligations, right? That's going to be your new mortgage payment. It's going to be whatever other monthly obligations you have that show up on a credit report, meaning credit card payments, car loans, student loans. But doesn't show up on a credit report is like your cell phone bills, your electric bills. I mean, there's other expenses in life. It's not like this is all encompassing. It's just whatever shows up on your credit report plus your mortgage payment. That's your monthly debt that the mortgage companies use. Now, what's crazy, Bob, is the mortgage industry divide that by your gross income. And the reason why I emphasize the word gross income is, I don't know about you, Bob, but I have to pay taxes, income taxes. So for some reason, the mortgage world says, here's your real dollars out. Here's your debt going out every month. And for whatever reason, we in the mortgage world divide it by a gross income number. So if somebody, let's use round numbers and call it 10 grand a month. We'll say that they make 120 grand a year, 10 grand a month. Again, there's taxes, but for some reason, the mortgage world doesn't do it. So if you save somebody between their mortgage payment, a couple cars, a couple credit cards, student loans, maybe they pay 4 grand a month total for all those things I just mentioned, divided by that 10 grand number we just gave, that's 40%. So in the mortgage world, they typically want 45% or less. It's kind of a generic statement, but it's a pretty good one. That says if you're at 45% your monthly expenses with your gross income, you should be good from a debt to income perspective. Again, that's DTI. And then when somebody says, how much house could I afford? That's the driving number that determines how much you can ultimately afford in terms of qualifying with your income. So it's a weird system to use that gross number, but we do, and that's how it comes. But that ultimately determines how much can you afford when qualifying for a home loan.
Yeah, that of course I would love to park here and ask more questions because that does make no sense because
None.
taxes are a liability. But that's a whole we'll be grateful for because it's
And there's other expenses too, right? I still got cell phone bills, and I still got utility bills, and I got other expenses. But if it's not on the credit report, it's not getting counted, which is really weird. So, and by the way, divorce decree, stuff like that, it's not on the credit report, but that does get counted. So there's some, but as a general statement, yeah, it's kind of a messed up number.
I was talking to a friend of mine. I was really surprised that he was about to close on a note, and yet his relationship with the IRS, or we'll call it a relationship because he owed quite a bit of money that he had paid back at the last moment, but he still wasn't current, and it just didn't seem to bother the underwriter. Why is that the case?
You know what? People make mistakes in life, and people sometimes, whether it's ignorance or just a bad decision. So there are folks that have obligations, and I like your word, relationships with the IRS. And if there's a payment plan in place, we know for a fact Uncle Sam's going to get his money. So if there's an agreed upon payment plan, and that payment plan is treated like a normal debt in those ratios we just talked about.
You brought up student loans. Let's talk a little bit about that. Of course, there's a whole lot of student loan debt out there. Let's say that these Parent Plus loans are something that parents have used quite heavily to finance the kids' college. And let's say that you've got a child who's a junior, and they're using student loans up until this point. They stop using student loans, and you declare that you're just going to pay for it out of pocket. Is that considered in that debt to income ratio, or how do they look at that? If you're saying to them, this is all we've accumulated, we're not accumulating anymore. How does that all work?
Yeah, great question. That's certainly complicated. You're right. There's a lot of different structures and different types of payback repayment plans for student loans. And the generic answer is if they have to make a payment within the next 3 years, we have to count that payment against them. So unless it's deferred for some period of time, which is rare, because there's a lot of times that are deferred for 12 months, they're deferred for, until something happens, or they can consolidate and they can do all this other stuff. There's a whole bunch of different types out there. But the generic answer is if there's a debt obligation, we're going to have to count it if it's coming due in the near future, in the next 3 years. So, I mean, it's always going to get counted, even if you can say, man, I don't have to make those payments today. And I know a big deal 2 years ago, I guess it was probably about 2 years ago, when there was all the talk of, the government just wiping out the student debt for a lot of folks. People are like, well, I'm not going to pay it. Look, at the end of the day, until it's gone, it's there, and we got to count it against them. So the short answer, we do count it. Now, if somebody's paying it on your behalf, mom and dad have been making payments for the last year, with proper documentation, we can exclude that debt. But as long as it's there, it's at least got to be addressed and considered debt.
Good information, Mark. If you want more information about Mark Pfeiffer, go to www.mortgagemark.com. And Mark, always appreciate you and you giving up your time to come on the program and educate listeners on what they need to know.
I appreciate you having me, Bob. Love our time together.
Absolutely. We'll talk next month. This is Bob Brooks. If you have a question for me, please go to the website at prudentmoney.com and send it in because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.